Hi, folks. My name is Mike Zlotnik, and today we're going to do an educational webinar on tax saving strategy, how to convert traditional IRA to Roth via a growth fund. It's a tax saving strategy that may come very handy in your financial planning. Let's go to the disclaimer. Wonderful disclaimer. This presentation is not an offer to sell nor any kind of advice. This is purely for informational and educational purposes. If you like what you hear, consult with your attorney and CPA professional before making any investment decisions. If you're interested in any of our funds, please request a PPM, private placement memorandum, to accredited investors only. Appreciate your time and attention in advance. Just a couple of words about us. I'm the CEO and founder of KF Management Group. You see here the leadership team. We have a number of other folks, and we pride ourselves on serving high net worth investors through our family of real estate funds. So you see Alina, our head of investor relations. You see Lilia, our office manager. We have two Yuris, Yuri N and Yuri G. There's me and a few other folks. Why people invest with us? Experience. We've been at this business since 2009. We have a strong track record, and we love what we do. We're very passionate about it. Our family of funds are funds of funds. We run them with a broad diversification in mind. Each fund diversifies across many dimensions of diversification. So when you participate in one of our funds, you spread the risk among many strategies, among many locations, many operators, and so on and so forth. We provide the best access point to the deal flow. Our funds invest into many deals not available to public, and by investing with us, you're participating in these great off-market deals. Business philosophy: our investors come first. We pride ourselves on white glove service. We use third-party reputable securities counsel, SEC counsel, as well as third-party fund administrator and onboarding platform. We communicate well. We communicate often. Online portal, quarterly statements, investor updates, Zoom calls, annual meetings, and so on and so forth. So why consider converting traditional IRA to Roth? Well, unless you like paying taxes, this is an opportunity to save on taxes. So you could pay taxes today based on the conversion value, and don't pay taxes in the future when you take distributions from a Roth IRA account. Traditional account, generally speaking, you pay the taxes when you take distributions. So if you've got enough years before you're planning to take distributions from your IRA, you may consider the strategy, converting from traditional to Roth and paying the taxes today and saving in the future. And today's rates are generally considered to be lower than the future tax rates. This is a generally accepted theory that the tax rates are going up in the future. So the conversion can make really good sense today, especially if you can save on the conversion value. We'll talk about this in just a minute. So what is the typical process to convert from traditional to a Roth? Depending on what IRA custodian you use, many of them have a pretty similar process. So step number one, typically they have a form called Roth conversion form. And generally speaking, they will allow to convert traditional, SCP, and other forms of IRA that is a pre-tax money. The Roth is effectively a post-tax money. So when folks contribute to a Roth IRA account, it is post-tax money, and the withdrawals are tax-free. But the first step is to complete a form. The second step is to basically go to your fund manager, whoever you invested with. When you're converting, you can convert in cash. We'll talk about that in a second. You can convert to an investment. But if you're converting through an investment, you basically wrote a check from your traditional IRA into an investment. And that at that point, whoever you invested with, their fund manager or fund administrator has the investment registered. And that registration needs to be updated. There needs to be a letter stating that there's a conversion from a traditional account to a Roth, acknowledging the changes in the account numbers as well. And in addition to that, you'll need the fair market value form. That leads us to step number 3. So once you completed step 1 and 2, so step 3, essentially, most of IRA custodians require a fair market value form. Fair market value form is simply a form at which value you're converting your investment. Typically, you need some kind of validation or an evaluation by a CPA or a professional valuator who can write you a letter of opinion of what this investment is worth. And that is a required documentation by most of IRA custodians. Once you have all those 3 things, you can complete conversion from traditional to Roth. Now, there are 2 primary conversion options. You can convert in cash. So you have cash in the IRA account, you do the paperwork with your custodian, say, I'd like to convert that from traditional to Roth. They convert, and you pay the taxes on the amount of the dollars you converted in cash. So the best, if you choose to use that strategy, the best time to convert is typically very early in the year, because the taxes on the conversion value will be due at the end of that year. So most people do this strategy, and I did it years ago, converting in cash, which I believe not the most efficient strategy, but I didn't know better then. So today I know better, but you will benefit from the knowledge of this webinar. In essence, you will have the opportunity to avoid the mistake that I made years ago. Again, the strategy on the left, cash conversion, in my opinion, was a mistake for my personal situation. However, it is different strokes for different folks. For some folks, it makes sense. You certainly can do that. That's an available option to you. So if you convert in cash, better to do it early in the year, and or you could do it very late in the year when you know that your income tax for that year is low, because you're basically you're paying taxes on the conversion value, and that is added on top of your tax, the highest tax bracket you're in. So if you know you had a low income year, and that may be an opportunity to convert in cash from traditional to Roth. There is a better strategy. So a better strategy, you can convert an asset or an investment. So you invest from traditional IRA, and then you do a conversion. So you're not converting cash, you're converting an investment. And then you will pay the taxes on a fair market value of the investment at the time of conversion. That's the critical requirement. And you decide when you want to convert. And if you invest it into a long-term fund that has no liquidity mechanism, really important point. The fund, you have to stay in the fund for the life of the fund. You can receive a discount typically to the invested cash due to the lack of liquidity, because you can't redeem. The cash is illiquid, and if you try to sell that investment, which you really can't, you'd have to substantially discount it trying to liquidate the investment. There is absolutely valid argument in that discount for lack of liquidity. The other thing that you get discount for is a lack of control. You invested, you have no control over the investment. Typically, a fund manager has the control, and you can get a discount for lack of control. There is substantial case study that these arguments are valid. I'm not a CPA. I don't play on TV. So I'll make this disclaimer one more time. Consult with your CPA professional before making investment decisions. I believe this argument is valid. However, I'm not licensed to give advice, so I'm not doing that. But I believe it is a solid argument in my opinion. So conversion needs supporting documentation. For example, when you convert an investment, let's just say in a fund, you can collect your last quarter statement from the fund manager, and also receive a letter of opinion from a CPA or evaluator stating the current fair market value based on the statement itself and the lack of control and the lack of liquidity. And the combination of those items can generate substantial discount to the cash invested. It is something that many folks have used in the past. They've made investments and they've converted, saving substantial amount of value by converting at a fair market value lower than the invested cash. So here is an example. The savings could be substantial. So let's look at a scenario where an investor wrote a $100,000 check into a growth fund. And this investment gets reviewed by CPA who's familiar with the conversion process. We do know folks who do this, the folks in our network who are professional, licensed CPAs who do issue these kind of letters. So if your CPA is not comfortable doing this and you are one of our investors, we will certainly introduce you to that CPA who writes these type of letters. And the CPA needs to look, generally speaking, at the fair market value of the investment at the time of conversion and discount for lack of liquidity, especially as I mentioned, if a fund has no redemption mechanism. And then lack of control, as a passive investor, you have no control over the investment. As a result, you could receive a discounted fair market value. For example, you could receive a letter from a CPA stating that your $100,000 investment is worth now only $50,000, depending on the three items above. And that conversion takes place at that lower tax value. And you pay taxes on the conversion value. So instead of paying taxes on a $100,000 conversion in cash, you're paying taxes on $50,000 of conversion value. So that is substantial tax savings. You can compare and contrast and make your own decisions. Just a couple of words about our Tempo Growth Fund 2. So we designed this fund to be really IRA friendly, and we've created two classes of units within the fund. Class A preferred units, they work really, really well for IRA investors. These units don't take any losses. They're safer. They are IRA friendly, and they have high pref of 12%. So these units are ideal for an IRA investor. And you can do this conversion through the investment in Tempo Growth Fund 2. It works. Certainly consult with your attorney and CPA, but that is what the benefit of investing in the fund. Of course, you're investing for long-term growth with a target annual return of 13 to 17%, but the preferred return is 12. And investors in Class A units also capture an upside in the, what we call them, performance split. So folks in Class A receive 12 pref, and they receive 30% of the upside in the fund once the pref is paid, and return of capital to both units is Class A and Class B. So the waterfall, or the way the cash is distributed, it pays 12% cumulative preferred return to Class A investors, and pays 8% cumulative preferred return to Class B investors, then returns the capital to Class A investors. Typically, folks who participate in Class A, that's why it's safer. Then returns the capital to Class B investors. And after all the principal is returned to all investors, that's when the performance split kicks in. So this fund is a growth-focused fund. This fund has no liquidity. Once you invest, you are in the life of the fund. The projected timeline of the fund is 5 to 7 years. Some investments may exit earlier, so some cash may come back a whole lot earlier, but the full life cycle of all investments is projected to be 5 to 7 years. We diversify across many dimensions of diversification. As I mentioned, you could enjoy tax benefits through this conversion. And it's a closed-ended fund, meaning that we raise the capital. Once we raise all the capital in the fund closes. We don't take any more capital. All the dollars are invested in multiple projects. Those projects live their life cycle, and then as investments cycle back, we repay our investors, first preferred return, then return of capital, and then the performance splits. And that's how this fund functions. What do we invest in? So we invest in a broad range of deals. We invest into a number of strategies. So in the value-add commercial real estate space, we invest in storage, multifamily, industrial, and other asset classes. We also like to invest in the hotel to multifamily conversions, office to multifamily, retail to storage. We're very opportunistic with capital allocators. We see great deals through our network of phenomenal operators, write the checks for the best operators. We also invest in distressed and discounted commercial debt, typically secured by low LTV, low to value ratio real estate. All we do is real estate, just to be clear. So the fund diversifies among many strategies, as you can see here. We use great SEC counsel. We have two firms that we work with, Pina Nicholson Law, and we also use Stoll Rives LLP. And we use third-party fund administrator Verivest, and we are one of the Verivest verified gold funds, fund management companies. You could find us on Verivest. You can certainly do your background and due diligence. We appreciate your time and attention. And the Armanino is our fund auditor. Not all funds are audited, some are audited, and we do audits as required. And we appreciate your consideration. If you have interest, questions, or would like to learn more, please reach out to Alina. Alina leads our investor relations. She's wonderful. Please take the opportunity to speak with her, ask your questions, request PPM, private placement memorandum. That's the formal offering document to this and other funds. We appreciate your time and attention and look forward to serving you in the future again. Thank you so much.